How Bank of China was caught evading taxes worth 236.7 billion Chinese yuan. How exactly did this happen? Hello everyone. Today we're breaking down a huge cases newly exposed by China's National Audit Office, which has sent shockwaves across the entire asset management industry. On June 23rd, the National Audit Office submitted its 2025 Central Budget Audit Report to the National People's Congress, directly naming Bank of China a systematically planned tax. An evasion scheme that lasted 2.5 years has been fully exposed, with the total amount of unpaid taxes hitting 236.7 billion yuan. Let me put this massive number into perspective. This sum is enough to build multiple public schools or funding livelihood subsidies for hundreds of thousands of local residents. What makes this scandal outrageous is the method Banks of China used. Instead of falsifying invoices or hiding revenue, it came up with a tricky loophole strategy. The bank asked its tens of thousands of employees to contribute tiny sums ranging from 1 yuan to 100 yuan each as nominal investors. By gathering these individual small stakes, it rebranded 11 private funds to disguise them as tax-exempt public funds, openly exploiting national tax preferential policies for its own gain. The National Audit Office has labeled this incident a typical major financial risk case, formally compliant on paper, but illegal in essence. Today, we will walk through the whole illegal operation step by step, analyzing existing policy loopholes, and talk about the massive penalties Banks of China will face afterwards. First, let's clarify a core background knowledge. Why does China grant corporate income tax exemptions to public funds, while private funds get zero tax benefits at all? The original policy intention is straightforward. Public funds belong to inclusive finance products open to ordinary retail investors. Anyone can invest with just a few hundred yuan, and they raise capital publicly from the whole society. Therefore, official fiscal regulations stipulate that capital gains earned by public funds from stocks and bonds trading are temporarily exempt from corporate income tax. This policy is designed to lower the wealth management costs for regular people and encouraging public participation in the capital markets. Private funds operate under completely different rules. They target high net worth investors with strict qualified investor requirements. Individual investors need to put in at least 1 million yuan, and private funds cannot be publicly advertised with tight limits on the number of holders, since they only serve a small groups of wealthy individuals rather than the general public. Private funds are excluded from tax exemption policies, and all investment gains generated must pay full corporate income tax. Simply put, identical investment profits are tax-free under a public fund label, but fully taxable as a private fund. This massive tax gap is the core reason why Bank of China took such a risky move. The entire illegal operation ran from April 2023 to August 2025, spanning 28 months. It was not an accidental mistake by a single staff member, but a standardized arbitrage plan designed from top to bottom, consisting of 3 interconnected steps. Step 1. Build a 2-layer business structure to block internal supervision. Bank of China used 2 of its own licensed financial subsidiaries as isolated, intermediate channels. All funded businesses and capital transfers went through these shell entities. Relying on internal barriers between subsidiary departments, the bank avoided thorough inspections from the head offices, internal risk control, and tax departments, hiding the whole violation within multi-layered corporate structures to prevent internal self-audit detection. Step 2. Gather nominal employee shareholders with minimal capital to fake the holder structure of public funds, which is the most controversial part. To meet the public filing standards, for public funds regarding investor quantity and public fundraising. Bank of China mobilized massive numbers of regular employees to invest merely 1 to 100 yuan each in these funds. Such tiny contributions created almost no financial pressure on staff, allowing the bank to quickly accumulate enough registered holders. From official filing documents, industrial registration records, and shareholder lists, these 11 products fully satisfied the qualification requirements of public funds. However, everyone knew clearly that employees were only listed as nominal holders. The actual capital source and underlying the investment logic remain private funding structures all along, while employees' small investments acted as a fake outer shell. Step 3. Rebrand 11 private funds in bulk to claim tax exemptions, evading taxes continuously for more than 2 years. After the packaging was completed, these essentially private fund products applied the corporate income tax exemption policy exclusively for public funds. Over 2 years, all trading gains avoided corporate tax declarations, resulting in a total tax evasion of 236.7 billion yuan. The audit report emphasized that this is sophisticated. Technical violations, all paperwork, and formal procedures are legally compliant on the surface. The bank used a legal shell of employees, micro-investment to cover up its illegal act of disguising private funds as public funds for tax benefits, making it a long-term, systematic financial arbitrage scheme deliberately planned in advance. Now let's talk about the severe consequences of this behavior. First, it directly erodes national fiscal revenue. The loss of 236.7 billion yuan in tax funds means public money, originally reserved for people's livelihoods, infrastructure, and public services, vanished completely. According to synchronized audit statistics, total corporate tax evasion across all industries nationwide stood at 1.09 billion yuan, and Bank of China alone accounted for nearly 1/4 of this total, which is astonishing. Second, it severely undermines fair competition within the financial industry. Other compliant banks and asset management institutions strictly distinguish between public and private funds and pay taxes in full. As a state-owned mega bank, Bank of China leveraged its extensive branch network and staff resources to create fake structures for illegal arbitrage, lowering its operational costs through violations and creating unfair competition against law-abiding peers across the sector. Third, it damages the credibility of state-owned financial institutions. As a time-honored major state-owned bank, Bank of China is supposed to set an industry benchmarks for abiding by tax laws and regulatory policies. Instead, it deliberately exploited policy loopholes, revealing complete internal control failures across its asset management, risk control, and tax departments. So far, Bank of China has only issued a formal statement saying it would sincerely accept the audit results and make immediate rectification, without mentioning core issues including tax repayment, disciplinary accountability, and fines. Nevertheless, based on China's tax collection and administration laws and relevant criminal law provisions, 3 major penalties are certain to be imposed. 1. Full repayment of the 236.7 billion yuan evaded tax, plus daily late payment surcharges at a rate of 0.05%, accumulated over more than 2 years. 2. Tax authorities can impose fines ranging from 50% up to 5 times the total evaded amount, meaning the maximum fine could exceed tens of billions of yuan. 3 are in charge of executives, business supervisors, and frontline staff involved will face disciplinary penalties and revoked financial practice qualifications. given the case amount far exceeds the criminal filing threshold. Relevant responsible personnel may even face criminal charges for tax evasion. Besides that, regulators will launch comprehensive inspections on all existing funds and channels. Businesses under Bank of China to clear out similar illegal products. The whole financial industry will also strengthen thorough penetration checks on actual fund holders of public and private funds, permanently closing this loophole of fake shareholder arbitrage. This case has sent a strong warning to the entire financial sector. Tax incentives are national policy dividends designed to support inclusive finance and must never be abused by financial institutions as a shortcut for better performance. Moving forward, regulators will no longer only review superficial compliant documents, but trace underlying capital and real beneficial owners. Any arbitrage through structural packaging or fake personnel records will face joint crackdowns from audits, tax and financial regulatory authorities. State-owned financial institutions with massive resources and distribution channels must stick to compliance principles and refrain from damaging national finances, income, and market fairness for short-term business performance. I'll keep tracking updates on Bank of China's tax repayment amount, final penalty results, and executive accountability, and share new information with you once it comes out. That's all for today's analysis. If you have questions about tax rules for public and private funds, leave a comment below. See you next time.